Render unto Caesar, a crypto tax primer. Crypto taxes can be complicated and overwhelming, but with the right knowledge and good record keeping, you can greatly simplify your annual tax filing. First things first, it's important to understand that the IRS considers cryptocurrencies to be property, not currency. This means that gains and losses from cryptocurrency transactions are subject to capital gains tax. 1. Capital gains. Capital gains refer to the profits that an individual earns from the sale or exchange of a capital asset, such as real estate, stocks, or cryptocurrency. Capital gains tax is a type of tax levied on these profits. It is calculated by determining the difference between the sale price of the asset and its original purchase price. When you trade cryptocurrencies, you must keep track of the date and amount of each trade, as well as the purchase price and sale price. This information is necessary to calculate your capital gains or losses. To calculate your gains or losses, you'll simply need to subtract the purchase price from the sale price. If the result is a positive number, you have a capital gain. If it's negative, you have a capital loss. When it comes time to file your taxes in the U.S., you'll report your capital gains and losses on IRS Form 8949 and Schedule D of your tax return. If you held your cryptocurrency for less than a year before selling it, your gains or losses will be classified as short-term. If you held it for more than a year, they'll be classified as long-term. In general, long-term gains receive more favorable tax treatment than short-term gains. It's important to note that not all cryptocurrency transactions are subject to capital gains tax. 2. Staking and lending. Some crypto transactions, such as staking or lending, may be classified as income and taxed accordingly. When you stake or lend cryptocurrency, you are essentially earning interest on your investment. This interest is considered income and must be reported on your tax return as such. To calculate the amount of income you earned from staking or lending cryptocurrency, you'll need to track the amount of cryptocurrency you staked or loaned, the duration of the stake or loan, and the interest rate or yield. You'll report your cryptocurrency income on your tax return as either ordinary income or self-employment income, depending on your individual situation. It's important to keep in mind that cryptocurrency income is subject to the same tax rates as any other type of income, which are usually higher than capital gains tax rates. This means that if you earn a significant amount of income from staking or lending cryptocurrency, you may be subject to a higher tax rate. 3. Mining and masternoding. It's important to note that cryptocurrency mining and masternode income are also subject to taxation. When you mine cryptocurrency, you are essentially earning income for the work that your computer is doing to verify transactions on the network. Similarly, when you operate a masternode, you are earning income for providing a service to the network. To calculate the amount of income you earned from mining or operating a masternode, you'll need to track the amount of cryptocurrency you earned, the duration of the operation, and the value of the cryptocurrency at the time it was earned. You'll report your cryptocurrency mining or masternode income on your tax return as either ordinary income or self-employment income, depending on your individual situation. It's important to note that if you are mining or operating a masternode as a business, you may also be eligible for certain tax deductions, such as business expenses or equipment depreciation. There are a few other areas of taxation that you should be aware of when it comes to cryptocurrency. 4. Exchange fees. If you buy or sell cryptocurrency on an exchange, you may be charged fees or commissions. These fees are usually deductible as investment expenses, so it's important to keep track of them so that you can report them on your tax return. Any fee you paid to buy a coin or token adds to your purchase price. Similarly, any fee you paid to sell that coin subtracts from your sale price, thus reducing the capital gain. 5. Charitable donations. If you donate cryptocurrency to a charitable organization, you may be eligible for a tax deduction. The tax deduction is generally based on the fair market value of the cryptocurrency at the time of the donation. 6. Foreign crypto accounts. If you hold or trade cryptocurrency in a foreign exchange or wallet, you may be subject to additional reporting requirements, such as filing an FBAR, Foreign Bank Account Report, or FATCA, Foreign Account Tax Compliance Act, form with the IRS. 7. Private transactions. It's important to note that cryptocurrency transactions between two parties are considered taxable events, even if no cash is exchanged. For example, if you trade one cryptocurrency for another, you may be subject to capital gains tax on the difference in value between the two cryptocurrencies. 8. Record keeping. As always, it's important to keep track of all your cryptocurrency transactions. One way of tracking this information is to use a simple spreadsheet such as Microsoft Excel, Google Sheets, or Apple Numbers. Here are some tips to keep in mind. Create separate columns for each relevant piece of information. This includes the date of the transaction, the type of transaction, such as buy, sell, trade, staking, mining, the cryptocurrency involved, the amount of coin, and its market value at the time of the transaction. Use formulas to automatically calculate the capital gains or losses for each transaction based on the value of the cryptocurrency at the time of purchase and the value at the time of the sale or trade. Include a column for fees or commissions paid for each transaction, as these can be deducted as investment expenses on your tax return. Also include a column for any income or yield received from staking, lending, mining, or masternoding. Create separate tabs or sheets for each tax year, so that you can easily keep track of your transactions for each year. Consider including a notes column where you can add any additional information about the transaction, such as the reason for the transaction or any special circumstances. If you take a few moments each week to update your transaction information, preparing your taxes at the end of the year will be a simple matter of transferring the data to the proper IRS forms. Conclusion. Render unto Caesar. Crypto investors should have a responsible and proactive attitude towards taxes. It's important to understand that taxes are a necessary part of participating in any financial market, including the cryptocurrency market. As the ancient saying says, render unto Caesar that which is Caesar's. This means that you must take seriously your obligations to pay any taxes that are due to the government, Caesar. Cryptocurrency investors should approach taxes with a mindset of compliance, accuracy, and transparency. This means keeping accurate records of all cryptocurrency transactions, understanding the tax laws and regulations in their jurisdiction, and seeking professional advice when necessary. Failure to comply with tax laws can result in significant penalties and legal consequences. Additionally, cryptocurrency investors should be proactive in staying informed about any changes to tax laws and regulations that may impact their investments. This includes monitoring updates from tax authorities and seeking advice from a tax professional when necessary. Ultimately, having a responsible and proactive attitude towards taxes can help cryptocurrency investors minimize their tax liability, avoid legal issues, and ensure the long-term success of their investments.